Good morning. You're watching a home broadcast of Business World Live. I'm Danie Laurel. It's 10:30 a.m. this Friday morning in Manila. We are about an hour into the last trading day of this week. Let's go straight to our top story. The Asian Development Bank has further slashed its forecast for Philippine GDP growth this year, citing the effects of the pandemic in the first quarter. The lender now sees the local economy to shrink by as much as 3.8%. That's wider than its initial reading of a 2% contraction. The ADB is pointing out consumption and investment, which it said have slowed more than expected. The government placed the entire island of Luzon under an enhanced community quarantine in the middle of March, prompting the closure of businesses and public transport. Restrictions only began to ease in the middle of May. Now, if ADB's projection is realized, this would be the worst contraction since 1985, when the economy shrank by 6.9%. Aside from slow consumption and investments, the economy may also take a beating from a drop in remittances. BSP Governor Diokno says money sent from abroad may fall by 5% this year, which in turn could slow economic output by 0.4%. Oxford Economics says the Philippines' path to recovery could face a number of headwinds, noting that policy measures rolled out by the government are still, quote, meager. In fact, in its report, the Philippines recorded the second lowest score, next only to India in the projected recovery of 12 Asia-Pacific economies. Vietnam topped that list. Okay, I want to kick off the markets with a quick reminder of where we stand in terms of the COVID-19 crisis. You can actually see on the terminal here that the chart is still very much towards the uptrend. You can see that the worldwide cases of COVID-19 stand at 8.426 million cases, and we are now at 453,000 deaths. So definitely worse not yet behind us. Still a lot of worries on that front. In fact, Beijing also just raising emergency in the city again. That's after recording a surge in new cases since the lockdown measures were relaxed in the past week. So let's kick off with how the markets are moving in the rest of the region. Now, we actually had a very muted session in Wall Street on Thursday, and you can see here how Asia is opening rather mixed. It's been very, very mixed since the beginning of trade. And that despite the fact, there are a lot of things going on the oil front. For instance, oil actually rallied amid more output cuts, the latest being Iraq telling OPEC Plus that it will fully implement output cuts this month. And this despite the fact that there are more stimulus coming out in terms of fiscal policy and also monetary policy here. You've got actually the European Central Bank breaching or reaching another trillion-euro milestone. So it actually offered 3-year loans, and they were taken up, and that would actually add 548 billion euros in liquidity. And that's on the back of the Bank of England also buying back bonds, another 100 billion pounds of bonds to be bought back by the Bank of England. And this, of course, following the Fed also doing corporate buybacks, not doing a lot to stoke the markets, at least in Friday's trade. Let's take a quick peek at our local index. You've actually seeing us pulling back a touch. We are at 6324.31. That is down by 0.4% this Friday morning. You see, we've seen a bit of a topsy-turvy past 3 days of trading, and this was actually after us having risen by more than 1% yesterday in a rally. We were actually down for most of the day yesterday, and we did see a lot of bargain hunting towards the end. In fact, there's a lot of turnovers in yesterday's trade, more than usual. We had around 10.44 billion pesos worth of trades. You've also got a bright spot here, and I'll show you that chart, and that is the offshore investors finally buying back in. And you can see that little green line here amid a sea of red bar lines here. Finally, offshore investors buying in at 544 million pesos. Now, one thing to watch out for today, Cebu Pacific. I'll actually take out the airline stocks for you guys. They have announced that their ground handling firm is cutting over 1,000 jobs. That's actually by One Aviation Ground Handling Services Corp. And this is actually its second wave already of job cuts. They said they have close to 5,000 workers, so that's around 25% of workers already being let go. And that the last day of these employees will be on July 2020. So not very good news here. You're seeing Cebu Pacific also in the red together with the local boards, but more heavily hit. It's down by 3.5%. Now, one is actually letting go of employees, but you've actually got one company that is reopening, and we'll see how that one is doing. That is a casino, and that is Bloomberry. They're reopening their casinos and also resuming constructions of their new one. They will reopen at very limited capacity, however. So that was actually already on June 15. Now, Enrique Razon, who of course owns Bloom, says that it's still very early to say how the business will be performing. The Casino of Soler was shut down since mid-March. And they say that, with this crisis, even as they go through the pain, they're still on the lookout for potential opportunities. You can see Bloomberry actually bucking the sell-off. That is up by 0.14%. I want to do a quick peek on our lenders here. And this is after our central bank governor, Ben Diokno, gave several comments on the health of our financial sector. He did mention that the bad loans of the banks will not hit the Asian crisis peak. So he did say that there have been tests performed by the central bank, and they did show that the lenders can survive broad stress scenarios and also meet the high quality liquidity requirements. Note that the NPL ratio, so the non-performing loans ratio, rose to a peak in 2001 after the Asian financial crisis in 1997 to 17.3%, and that actually took several years. It took until 2005 before it returned to single digit level. He's saying it's not gonna be as bad, but you do still have a lot of worried people here. One, for instance, analysts have been looking at BDO as they said that they see slower loan growth and also more defaults, but they are, of course, in a position of putting provisions. So they did additional provisions of 20 billion pesos to be, as they say, more prudent. You can see how our banking sector has performed here. Another one that's very related, at least to the financial space, this is from Finance Chief Sonny Dominguez. He's now urging citizens to buy into the government and to try out government bonds. He's saying they need money, basically, to cover the deficits that are being brought about by a lot of spending from the COVID-19. He says that the pandemic has taken a toll on the budget of the government. And he's urging, actually, the winners should call those premio bonds that they had last year, use the money to reinvest in the Philippine government and also possibly start small business. Now, speaking of bonds to consider, I want to highlight one issuance that's very interesting. We've already reported this yesterday. That was BPI. They are planning to issue bonds to help MSMEs. We have more details on that. So they are calling this COVID Action Response Bonds, or CARE bonds. And the idea is that if you do buy into these bonds, the money that they will get will be financing eligible MSMEs, which are specifically hit by the pandemic. So they've already filed this with the PSE. They're saying that the SEC confirms that this qualifies under social bonds, under the ASEAN social bond standards here in the Philippines. So they're going to be using that to actually help out the businesses that have been hit. So it's actually very, very interesting. BPI has been very active in this. They had this green finance framework also for environmental investments that they rolled out in 2019. So definitely something worth watching. And finally, just to end this quick market hit, peso, I just want to take a quick peek at that. Of course, on the back of these comments of Ben Diokno, that we do have enough cushions in the banking space. We are trading at 50 spot 179, a bit of an uptick, so slight weakening compared to a few minutes ago, but nevertheless still hovering at those 50 levels. More markets later on in the broadcast with BDO Capital's President Ed Francisco. Meanwhile, let's check in on other headlines that we are watching this Friday morning. The PSA now estimates tourism's contribution to the economy in 2018 an eighth of GDP. This actually paints a picture of the sheer magnitude of the expected setback this year, with travel devastated by the pandemic. The PSA found that tourism's direct gross value added accounted for 12.3% of GDP in 2018. This is actually way above the average tourism share to GDP between 2000 and 2018, which in 2018, which stands at just 7%. Asian Institute of Management's Paulo Rivera said 2020 might see the industry reversing the most, if not all, of its gains in 2018 and 2019. And without the usual boost from tourism, he sees a drastic decline in growth, with postponed vacation plans, border closures, and strict stay-at-home measures. But Rivera said travel and tourism will, quote, slowly but surely reboot. That's once the necessary safety measures are put in place and a vaccine is developed. Now, another statistic dragged down by the pandemic is the government's excise tax collections from sin products. But the DBM says this will only affect the funding for universal health care 2 years down the line. Assistant Secretary Rolando Toledo explains that by law, sin tax funding for the UHC operates at a 2-year lag, so this year's collections will support the program in 2022. Now, this means this year's budget allocation for the program's main implementing agencies, the DOH and PhilHealth, will not be affected since funding will be based on 2018 collections. According to preliminary data, excise tax collections from alcohol and tobacco products dropped a whopping 99% year-on-year in April. Year-to-date, collections are down 39%. Despite the looming funding gaps, Toledo says the UHC remains one of the government's key programs, so it will surely be prioritized in its spending plan for next year. Meanwhile, it's not so fast for POGO firms. Tax authorities will be requiring them to settle a 5% franchise fee before they can resume their operations. The Finance Department says the Bureau of Internal Revenue is having a hard time collecting franchise tax from POGOs operating overseas. Now, while this can also be solved by passing a legislation that will strengthen guidelines, the DOF said there are various tools the BIR can use to immediately collect unpaid dues. POGOs have been allowed to resume partial operations in early May, provided they meet certain conditions, such as obtaining tax clearance covering income tax liabilities for last year and settling any unpaid franchise tax dues. The 5% franchise tax comes on top of PAGCOR's 2% franchise fee. Government tax collections from POGOs and their service providers more than doubled to over 6 billion pesos in 2019 from a year earlier. If there are no problems, there will be no opportunities for change. It's during the crisis periods where paradigm shift and innovation occurs, and some companies are getting ready for that hunt. Here to share with us where to find those opportunities, we have with us BDO Capital's President, Ed Francisco. Good morning, Ed.
Good morning, Danie.
Sir Ed, I'm really excited to talk to you today because usually we talk about stocks, but now I want to talk about capital, opportunities and investments in this period of a pandemic. I mean, we know that these are the periods where prices are depressed, bonds are a go, safe havens as well. So let's kick off with that. A lot of fundraising on the fixed income front. Let's kick off with PLDT's landmark Reg S bond, a US dollar bond, $600 million. How exactly will this impact their bottom line? How much are they going to save? Are they still they've cut their capex, but will this actually allow them to still continue with their plans?
Yeah, no, of course, the fact that this was hugely oversubscribed, right? I think 10 times, and then the
18 times, sir.
Yeah, and then margin over the government was parang less than 15 or 20 basis points only. So it was very cheap. They should be able to make good use of it, maximize it. And as they build out their rollout, I attended their annual stockholders meeting virtual, and it was very well presented. And I think they have continued to have huge plans anyway to increase the rollout for the rest of the country. So I'm very positive that they'll use the money.
Sir, why did they decide to do a dollar bond? So it's the first time they've actually tapped offshore debt. I mean, in 18 years, and others are actually looking at peso-denominated bonds. So looking at domestic. What's the difference here, and what does that say about offshore institutional investors still believing in the Philippine growth story?
Okay. So one, okay, I guess a step back, Danny. Number one, the fact that we're able to issue bonds in the Philippines and abroad shows that at least investors, local and foreign, still believe in the sustainability of our corporates. Otherwise, they will not be
Okay.
able to borrow. That's one. And then second, we continue to have lots of peso bonds, but the interest of the Philippine investors to date is in the shorter tenor, mga 2 years, three
Okay.
years. That's why we can talk about that more. The foreign investors, kasi they're mainly institutional, want naman longer term. So the PLDTs of the world, the Jollibees, the ICTSIs, because they have dollar revenues also, can hedge. So they're perfect candidates also for topping the dollar market. So they can get longer term tenor. So it's good also for them because they can hedge.
Sir, since you already mentioned it, why are the local investors just looking short term?
I guess the local investors naman, our market is not as developed as abroad, di ba? Kasi a big portion of the domestic market is retail, which is also good because
Okay.
tayo we can buy.
Retail
So
bonds,
maybe we're
yeah.
more conservative. We buy on the shorter tenor, and that's why even to echo what Sunny Dominguez mentioned, the RTBs, retail treasury bonds, or the premium bonds, in fact, for 1 year.
Mm.
RTBs generally shorter, 2 years, 3 years lang. So we're really more on the shorter side, not much on the long side. Except these are the SSS, the GSISS, but the rest are short. The foreign naman kasi mainly pension funds, retirement funds, madami sila. Then they have a bigger appetite for long term.
Okay, sir, just for PLDT, will they use, I mean, they've already been very clear that some of it will be going to CapEx and they're
Yes.
still going to be heavily leveraged. Is that not worrying for the company, especially since, I mean, it's crisis period, it's going to be very hard to get back that heavy spending? Um, or is this actually giving them a lot of reprieve because they have this new cash sitting there?
Yeah. I guess the fact that it's a long-term cash, 10 years to pay, and when it's a bond,
Mm,
there's no amortization.
baba.
You just pay bullet at the end of the 10 years. Gives them that breathing room. It's really very
Okay.
good anyway for intensive companies because you really need to spend capex anyway. And as we all know, I guess the revenues have gone up also in COVID. Other industries got hurt. Their revenues are up, which is great. But also
Mm,
because as we've been at home, right, we've been using data more. So their data needs are increasing. And if we really want to be more competitive globally, we also should be supporting these telecom companies as they build up because we need faster internet really, and even for the schools and for education of our
mhm.
kids, your kids, Danny, di ba? If you're
Right.
unless you want to be a full-time teacher also,
Mahirap, that's harder than my
then
job.
of course you want faster internet. Yes, I know you teach also. So it's good na that they're spending because they could just maximize profits. But if they don't
Mm.
spend, they won't be able to roll out, and we won't get better internet speeds. So I support them for this.
Okay. Now, but for us as individual investors, how do we see PLDT vis-a-vis the government bonds? Especially since, I mean, if we had invested in bonds last year, we'd be really, really happy. Right now, mababa na yung rate, diba? So, I mean,
Yes,
they've cut
yes.
the interest rate. So, is it still an attractive buy-in? I mean, it's attractive for the corporate, but for us investors, vis-a-vis how volatile equity markets are.
Right. As a general investor, bonds are safer than equity. There's less volatility, right? You have at least a stated fixed return as compared to equity where you're relying on the dividends. So that's why even I guess in more uncertain times there are more bond deals than equity deals. Now, PLDT relative to the government, PLDT is rated also. It's rated at the
Mm.
country risk of the Philippines, but even many years past, PLDT was always uh, constrained because of the rating of the Philippines, especially when we were still
Interesting.
non-investment grade. So
Oo.
the fact that the spread of PLDT over the government is very small
So
shows that they really are really well received. There's financial strength is recognized, and that's why they were able to get such good pricing.
very interesting. So let's move on to Jollibee, which has also done, but what they've called a precautionary fundraising. Now, a very
Yes.
interesting question is, I mean, they're not going to be using it to refinance. They're not necessarily going to be using it for expansion or capex. Why would this be interesting for investors if they're going to be just keeping the cash in case something bad happens? Is why would that be a business case?
Yeah. No, I mean, hats off to Jollibee because they've always been conservative. No, they have not really been borrowing. So if they tap this really more for precaution, and knowing how good their CFO group, their financials are,
Hmm.
they're always on the lookout for acquisition. So if they see a great potential acquisition here or abroad, they have the war chest to do that. At the
Okay.
same time, because they are I guess digesting these other acquisitions, right? They're rationalizing it. So I'm sure they can use that also to retrofit some of these stores or reallocate or capital. They will. I'm sure they will maximize the use of it because other if they don't have the use for it, then they can just declare dividends and give it to the investors.
Okay, because so you don't think they're cash strapped because they said they have 26.5 billion cash. So they, I mean, in theory, should that not be enough for cushioning the blow for precautionary measures? They need to tap more debt pa and be more indebted.
Yeah, no, they're just very conservative because they
Okay.
have huge lines, liquidity lines with the banks, including BDO. But generally, they never use it kasi they're again because of their
Hmm.
working capital cycle, di ba? Because sa stores, panay cash naman
Yeah,
ang bayad ng
bilis. Oo.
Pilipino. So there's really no receivables. So they're really doing this as a precaution. I think it's also very conservative. So the key really is to just to follow what they're gonna be doing now with the cash. As long as it's not just sitting on the banks and having a negative carry, meaning if they borrowed, let's say, at 3.9%,
Hmm.
if they're depositing it at 2% or investing at 2%, they're losing money, the 1.9.
Correct.
But
Yeah.
if they can use it and earn above their borrowing rate, then it's still a good investment for them. And I think they can do that.
Okay, so they can find somewhere to put it that it's not just sitting there. Sir,
Yeah.
ICTSI, another one that's cutting capex but fundraising. It's again, very, very counterintuitive, diba? Where are they gonna put the money na naman? Is it also refinancing? But they're also saying if they find interesting acquisitions, they're gonna take it. So what's the
Yeah.
story here? Which kind of capex are they actually cutting? Are those not projects that are not yet there, or what's the reallocation happening?
Okay. No, I very high regard anyway for Mr. Razon and his CFO, Sir Consing. Basically, the way we see it is if they cannot anymore expand in a certain port, then there's no need to put in more capex. If they say all the cranes are there and there's no more space.
Okay.
So the way for them to grow is to look for more acquisitions, which they've been doing. Admittedly, he was one of the first Taipans to say that this year is, di ba? He said let's write off
Oo.
this year,
Yeah.
let's look next year, which is actually very nice because he's still helping people, and yet parang from a
Oo.
shareholder perspective, umasa na lang tayo next year. So I think he wants to make bawi, and that's why even Bloomberg is reopening, right? But at least for
Tama.
ICTSI, knowing how aggressive they are, whether it be Africa, whether it be Middle East, if they see good opportunities, they will swoop down and look to invest. So it's good to have that war chest also because today cash is king.
Okay, but how would that affect? I mean, their share price. How do you value that? Because I mean, it's very difficult to say that they're cutting their capex by 41%. But if there's acquisitions on the table, they're going to take it. What is the market pricing in right now?
Yeah, so the price, I think it was around 100. I was looking at the price
It's
now
a
earlier.
hundred. Yeah.
Yeah, it's around 100, right? At least there's still a lot of upside anyway, where we
Okay.
BDO support them and believe that they're a buy. Um, I think the knowing how malikot they are in a positive sense, they will use the money. So capex sure is low now, but if they see the economy reviving immediately, Kasi in a way, international trade, shipping is what do you call it? It's a leading indicator, di ba, Danny? You're a doctor in finance. So it's a leading indicator. So they will know if the economy is improving. So if they see that TEUs or tonnages are going up, right? That's a signal. Then they will increase their capex again. So at least it's good that they have that flexibility. And even on the back, in the back, I know that they're so safety conscious. All their workers are tested for COVID. They're doing all these security checks to make sure that everything moves very well in their yards. So I'm very.
Are they liquid? Are they liquid, sir?
Oh,
in
yes,
this
yes.
kind of ano? Okay.
They're very
Kasi
liquid.
isn't it the long term? Okay. Okay. The working capital is
long-term,
actually
very
fast.
capital intensive. But I guess
Oo.
Mr. Razon has diversified businesses. So ICTSI is a cash co in itself, and then he has his casino, has his property. They're all doing very well. And then he's a very astute businessman, right? He's always on the he does not get he's not never in the radar screen of the politicians, diba? So he will be he will be there for the next few decades, and he already has succession planning with Christian and his daughter getting very involved in the businesses. So this is a long-term play, ICTSI and his businesses.
Okay, so still some upside there in terms of the share price.
Yes.
So let's talk about Ayala. How big of a deal was this Infigen deal that they were so excited over? And now, I mean, it's not yet over till it's over, but it seems their offer has now been trumped by the Spanish giant. Were you hopeful on that, and were markets pricing that deal in?
Anyway, because Ayala, anyway, when you look at Ayala Corp, diba, the energy, thanks to Eric Francia, is already getting bigger as a part of the total portfolio, right? But it's not yet chunky enough to really affect the stock price of Ayala, diba? In a way, it's getting bigger, but it's not that significant yet. So from a story perspective, of course, as a Filipino, we're rooting for the Ayala Group to have won it. Unfortunately, the other side paid more. The Spanish paid more. In fact, they paid a huge premium for it. I just don't know the number, but the article says what I was reading was that there was a huge premium, but they'll just have to
correct.
7.5%
more than the Ayala Group now.
Yeah, right. So it's sad. I know that the shareholders and the board already agreed to or endorsed Ayala's bid, but they were outbidded. But I think there will be more opportunities because anyway, Ayala is on the prowl, also looking for investments all over the world, diba? And they're very positive on, I guess even in Southeast Asia. Even the rest of the countries, I think, especially in infrastructure, they will continue to look, and they will win more deals.
Okay, and sir, somber mood muna on, of course, the death of ECJ, no? Of Dating Kuwangko. Does that in any way, it's a strange question to ask, but does that in any way affect the strategy of San Miguel Corporation? I mean, it's been quite clear that he's already handed the reins to Ramon Angal a long time ago, even in terms of shareholdings. But nevertheless, he's very active chairman of the board. To what extent should we expect some transition during this period?
Yeah, I think from a stock price and from business direction, we are, at least as an investment banker and one of their bankers, we do not see major changes. No, of course at the board level, I would be happy if RSA would be elevated to be the chair, or if maybe because of the family, one of the family members wants to sit in, that's okay. But in terms of direction, RSA has executed the plans and diversified San Miguel. It's really now, right? San Miguel Food and Beverage plus energy, infra, and all these other things. So they weather the crisis, and they have the airports and other projects. I don't think that will change. They will continue to grow. They're a major player now. They're one of the oldest anyway in Asia, largest breweries anyway, and diversified food and beverages. Of course, Petronas just not been doing well, but that's really the result of the industry anyway in oil. But the rest of the businesses have done well. Beer has not done well only because, of course, of liquor bans. But at least the pure foods, the meats have done extremely well. So we're continuously in touch with them. They're also they've raised PES bonds already. They continue to top the market. We don't see a problem also with them. So even if there will be board changes, management changes, I think are very clear direction, and the organization is very strong.
Okay, so last question on San Miguel before I let you go. Are they're highly leveraged? They're very leveraged compared to other big conglomerates, and the infrastructure play is very long term. There've been delays when in terms of getting the cash back, especially when you talk about the airports. It should have been there now. I mean, they should have broken ground. Are you expecting them to be refinancing, issuing more bonds, or following the steps of JFC or TEL in terms of contingency liquidity?
Yeah. No, them even on the quietly, they've continued to tap the international markets anyway. Again, one of their other
Dami.
advantages, they've also tapped the Japanese market because of their Kirin, their partners. It gives them that added advantage. So I do not expect them to slow down in terms of their acquisitions and their growth and even their borrowing. Now, regards to their leverage, I guess yes, nominally their leverage is higher than the other conglomerates, and I remember some rating agencies raising concern before. But we naman as a bank, we're not concerned because we know naman that there's cash flow and that there are plans behind all of it. Unfortunately, at the airport, even their failed telco, I didn't push through, but their airport, their road projects are delayed. But once those go on stream, then they'll do extremely well. So we're still very positive on the San Miguel Group.
Okay, so it's just a temporary setback, but they do have the long-term plans
Yes,
in play once things
nila.
start rolling.
Yep.
Thank you, sir. That was a very fun, insightful interview. That was,
Thank
of
you,
course, Ed
Danie. Take care.
Francisco. Thank you, sir.
Bye-bye.
And that's a first look into the business day. Today is June 19, 2020. Catch us again Monday, 10:30 a.m. Have a great weekend. I'm Danie Laurel, and we are One News.